Bay White Financial is a broker-dealer and wealth management firm that helps its clients manage their portfolios using standalone derivative strategies. A new Bay White analyst is asked to evaluate the following client situations. Match the following definitions with their corresponding forward pricing or valuation component. So number one, equal to the difference between the current spot price adjusted by remaining costs and benefits through maturity and the present value of the forward price. Well, this is the valuation of a forward contract. So let's see what we have. A is forward contract mark-to-market value at inception. B is the forward contract mark-to-market value between inception and maturity. This is what it sounds like because it's saying adjusted by the remaining costs and benefits. So it implies that we're already through some of the time period of the contract. And this is what it's saying. The difference between the current spot price adjusted by remaining costs and benefit, ST, minus the present value of the income plus the present value of the costs and the present value of the forward price. We're just subtracting the present value of the forward price. That is how we calculate VT at any point in time. 2, the future value of the underlying asset spot price compounded at the risk-free rate, incorporating the present value of the costs and benefit of asset ownership. And since we've already knocked off B, we can cross this off. C, the forward price. That's exactly what it is. This is just the underlying carried at an interest rate. We also know it is equal to S naught plus the present value of any costs minus the present value of any income. 1 plus R to the T, or we could do it as S naught 1 plus R, no, sorry, not 1 plus R, we already have that, E to the RT to match this one, and this one would be E to the R minus I plus C T, with S naught in front. So there is this one matched off with number 2. And all we have is number 3, and number 3 has to be A. Under no arbitrage conditions for a given underlying spot price S naught, that is the price at inception, adjusted by the costs and benefits, the risk-free rate, and the forward price, this should be equal to 0. What is equal to 0? The forward contract mark-to-market value at inception, B naught T equals 0. So here is the present value of the spot price, all the costs and all the incomes, and we're subtracting the forward price discounted all the way back to the beginning. These two terms should be equal to each other, making the value 0. A Bay White client currently owns 5,000 common non-dividend paying shares of VIVU, a digital media company, at a spot price of $173 per share. Client enters into a forward commitment to sell half its VIVU position in 6 months at a price of $175.58 US. Which of the following market events is most likely to result in the greatest gain in the VIVU forward contract mark-to-market value from the client's perspective? A couple of things to point out here. We're selling half the shares, so we have a short forward. It's the first thing we have to realize. If we tried to solve this using a long forward, it would have been a little bit puzzling. We have a short forward, so at expiration, as long as this term is greater than 0, we are in gains, right? That is the forward contract price of $175.58. As long as the stock price at expiration ends below that, we are in gains, and at any time from contract inception to contract expiration, depending on what changes, we may be in gains or losses. If you were so inclined, you could take the 173, notice that is non-dividend paying, there's no income, and equate it with the 175.58 with an interest rate. What gets it from 173 to 175 in 6 months? 3%. Okay, let's see. Which is going to, we're looking for most likely, right, lead to the greatest gain. Now, you can make the case that all 3 can lead to a gain if you make certain assumptions. But it's saying most likely. So in other words, for A, B, and C, even though you can make the case that all 3 would lead to gains, you have to make certain assumptions. So the most likely answer will be the one with the least amount of assumptions. A, an increase in the risk-free rate. Well, it doesn't tell me when the risk-free rate is going to increase, and it doesn't tell me by how much the risk-free rate is going to increase. So if I assume the risk-free rate increases at inception date, that means we would be discounting back the future price by a higher discount rate. It would end up being below whatever the current spot rate is. And if we apply this formula here, it would be less than 0, which is the realm of losses. But what if we get all the way to here and the interest rate changes and it goes to 3.000001%? Well, if you discount back this forward contract, and this is still the spot price, by just a slight amount higher, you might end up here, just below the line at 3%, because you're discounting back at a lower rate. The forward price is higher than the spot, you'd be in gains. But notice we had to make some assumptions about when the interest rate changes. So let's just say, okay, A, we can make the argument that we could be in gains, but we had to make assumptions. B, an immediate decline in the VIVU spot price following contract inception. So let's just take some of this stuff out of the way that we wrote, and we'll remove this. And if we have an immediate decline in the price, let's say it goes to this point. Well, we know that if we take the present value of the forward price, 175.58, discounted back, we would get to S0, not the lower price. Since it is above that price, it is a gain. We don't have to make any assumptions to know that we are in a gain on B. We had to make some assumptions on A. So what is most likely, B or A? B is most likely, because A, depending on our assumptions, could be a loss or it could be a gain. But B is going to be a gain. C, a steady rise in the spot price of VIVU stock over time. Well, here again, I have to make some assumptions. What if the stock price rises, instead of by 3%, what if the stock price rises only by 1.5%? And there is ST. Well, F0 minus ST is going to be greater than 0. That's a gain. So I could make the case that it could lead to a gain. What if it rises at 5%? ST minus F0, well, that will be less than 0. That would lead to a loss. So depending on the assumption I make, I can get a gain or a loss. So I could get a gain over here, I could get a gain over here, but I will get a gain over here. So which one is most likely, the one with the least amount of assumptions? We got to go with B. Okay, a bit of a wordy question here. A Bay White client has entered into a long 6-month peso USD FX forward contract. Let's make sure we know we're long. An agreement to sell pesos and buy US dollars. The peso USD spot exchange rate at inception is 19.8248. In other words, $1 US gets us 19.8248 pesos. The 6-month Mexican risk-free rate is 4.25%. The 6-month US risk-free rate is 0.5%. Bay White's market strategist predicts that the Mexican central bank will surprise the market with a 50 basis point short-term rate cut at its upcoming meeting. Which of the following statements best describes how the client's existing FX forward contract will be impacted if this prediction is realized and other parameters remain unchanged? Just something to be aware of here. We get what the author is saying, but it's sloppy, and I'll tell you why. These are bank rates. These are not government rates. These are bank rates. Even if the Mexican central bank cuts short-term rates by 50 basis points, because these are interbank rates, there's no guarantee that the interbank rate will also drop by 50 basis points. It could drop by 40 basis points or 35 basis points. So there's no guarantee that it's going to be a one-for-one. These are not overnight lending rates that we're using. These are bank rates or market reference rates. So we get what the author's saying. We're going to lower the interest rate from 4.25 to 3.75, but it's just sloppy writing. Okay, which of the following statements best describes how the client's forward contract will be impacted if this prediction is realized and other parameters remain unchanged? So we're long. That means we're going to take delivery of US dollars and we're going to pay pesos. Pretty much what this says here. We're going to an agreement to sell. I don't like it when we say we're selling the pesos and buying US dollars. We're taking delivery of US dollars and we have to pay pesos. I wouldn't go to the store and I say, excuse me, I got to go sell some of my Canadian dollars for some Diet Coke. I'm buying Diet Coke. I'm paying Canadian dollars for my Diet Coke. I'm not selling my Canadian dollars and taking Diet Coke. So because this is an agreement to buy and sell the base, we are taking delivery of US and we pay the price. We're not selling our Mexican. We're paying, sorry, we're not selling our pesos. We're paying with pesos. Just, you know, the language, right? I don't like it when it you know, is sloppy in the language. So, let's go. The lower interest rate differential between the peso and US will cause the peso-US contract forward rate to be adjusted downwards. Now, you may read that and go, that's exactly what would happen. The forward rate would drop. It says the contract rate would be adjusted downwards. No. Contract terms do not change. Once you enter into that contract, they are fixed terms. The value of your contract may change because the mark-to-market may change, but you cannot change the terms in the contract. So we can get rid of altogether. The client will realize a mark-to-market gain on the forward contract due to the decline in the Mexican versus the U.S. interest rate differential. And C says the opposite. The lower interest rate differential will cause the client to realize a mark-to-market loss. So do we have a gain or do we have a loss? Let's find out. If we take the spot rate at 4.25% and discount it at 0.5%, we get a forward rate of 20.5654. Let's lower the rate by 50 basis points. We get 20.4659. We are long. We're long. We want that forward price to be higher. This forward price is lower, which means we do not have a gain. We have a loss. We can get rid of B. This is saying we have a loss. That is exactly what we have. A client seeking advice on her fixed income portfolio observes the price and yield to maturity of 1 year and 2-year annual coupon benchmark bonds currently available in the market. Which of the following statements best describes how the analyst can determine a break-even reinvestment rate in 1 year's time to help decide whether to invest now for 1 or 2 years? Well, what are we looking for when we say a break-even reinvestment rate? We're looking for the implied forward rate. It says here in 1 year's time. So the implied forward rate in 1 year for 1 year. We also have annual coupon government benchmark bonds. We have a 1 year and a 2 year. We need spot rates to be able to calculate the implied forward rate, not yields to maturity. For the 1 year, it doesn't really matter. Present value is equal to, what are we going to have? We're going to have our coupon, plus we're going to have our present value. And it's just discounted at one rate. So it really doesn't matter. Whatever R1 is good, we can use it. But we can't use R2. What we have to do is take payment, 1 plus R1 plus payment, plus future value, 1 plus R2 squared, and equate that with our present value. This is a known, and we have to solve for the unknown to get a spot rate. Let's see what we have. A, as the 2-year rate involves intermediate cash flows, divide the square root of 1 plus R2 by 1 plus R1 and subtract 1 to arrive at a break-even reinvestment rate. Well, you cannot use, you can use R1. Sorry, let me back that out. You cannot use R2 because R2 is a yield to maturity, not a spot rate. Get rid of A. Since the first year's returns are compounded in the second year, set 1 plus R1 multiplied by 1 plus the break-even reinvestment rate, so far so good, equal to 1 plus R2, and that's where it falls apart. Can't use that. It's not a spot rate. It's a yield to maturity. So we can get rid of B. Since the break-even reinvestment rate involves a zero coupon cash flow, first substitute the 1-year rate, R1, into the 2-year bond price equation to solve for the 2-year spot or zero rate Z2, which is what we're doing up here. Then set 1 plus R1 times 1 plus the break-even reinvestment rate equal to 1 plus Z2 squared, and Z implying that we have a zero rate and not a yield to maturity. That is exactly how you would do it. Bay White Financial seeks to gain a competitive advantage by making margin loans at fixed rates for up to 60 days to its investor clients. Since Bay White borrows at a variable 1-month market reference rate to finance these client loans, the firm enters into a 1-month FRA contract on 1-month MRR to hedge the interest rate exposure of its margin loan book. Which of the following statements best describes Bay White's interest rate exposure and the FRA position it should take to hedge that position? Well, what's it doing? It lends for 2 months, right? It's making margin loans at fixed rates for up to 60 days. And how's it financing its lending book? It borrows for 1 month at a time, but it lends for 2 months at a time. So it borrows for 1 month, then borrows again. So you have rollover risk. You borrow for 1 month, then you roll it over, then you roll it over, but you're lending for 2. So what do you not want to happen? You don't want the market reference rate in the second month to go up. There's your risk. The risk is that the rate goes up. Well, if the rate goes up, it's going to cost us money. So what we want to do is we want to profit if the rate goes up, so we go long. We will go long the rate. It pays off if the MRR is higher than the IFR. So we're going to pay the IFR, the implied forward rate, that is the fixed rate, and we're going to get the market reference rate, which is the floating rate. Why are we paying the fixed rate? Our risk is if the market reference rate goes higher. So why not say, look, we'll pay you the fixed rate, and if the rate goes higher, we'll get the market reference rate. And since the market reference rate will be higher than the fixed rate, it'll pay off, which will offset our higher borrowing cost to our clients. So we're looking for the interest. Which of the following statements best describes our interest rate exposure and the position it should take? Bay White faces exposure to a rise in 1-month MRR over the next 30 days. That's exactly what we face. So it should enter the FRA as a fixed rate payer. There we are. There's the payer. The IFR is the fixed rate as a fixed rate payer in order to benefit from a rise in 1-month MRR above the FRA rate and offset its higher borrowing cost. That's exactly what we should do. Bay White faces exposure to a rise in 1-month MRR over the next 30 days. You would say, okay, you got me. I'm saying yes. So it should enter into the FRA as a fixed rate receiver. Not a fixed rate receiver. We need to be a fixed rate payer. Because if this rate rises and we're a fixed rate receiver, we would then have to pay the higher MRR. We don't want that. So we can get rid of that one. Bay White faces exposure to a decline in 1-month MRR. No, we've already said our risk is to the upside, not the downside. We can get rid of that one right away. A.